Okay, let's get right into it. Lots to cover today. Um, we had a January call. Things were good. Just came off our best LePoidevin Group back-to-back years. And we had a call, but I was a little cautious. So let's get into it because a lot has changed. Obviously, headlines of the war in Iran, but that has implications for economically and investment wise. Again, not politics here. Um, we talk about where money is going and where we think there are bargains. Just an update. Dow Jones, this was midday yesterday. Things are down a little bit today, about 0.5%. Dow Jones minus 3.4. Toronto Stock Exchange eked out a gain 1.7. We'll go into that in a moment. S&P 500 minus 3.7. Little bit of losses in the bond market, both in the Canada and the United States. Those poor bond guys have been struggling now. This is 5 years in a row. World stocks, a small gain, again, outperformance of the United States. Gold 5.6 was higher. Big move, of course, as you know, is the price of oil. Brent, West Texas, I've got on the chart here, both are surging, Brent even more. The Canadian dollar, ironically, has weakened against the US dollar. Notables, S&P equal weight. Oh, that's interesting. So the equal weight means that you own 500 companies. The index, the S&P 500, owns 500 companies as well, but they're heavily weighted to the bigger companies. So if you own the 500 companies, but you didn't have such a high proponent of Apple, for example, and you owned a regional bank at the same weight, you're up 0.7, so not a loss. The big loss is in the biggest technology companies. Jim Cramer coined the phrase the Magnificent Seven. That seems to have stuck. The seven companies were representing 40% of the stock market. Magnificent Seven is now, as we speak, having another bad day, minus 12. Russell 2000, which is what we would call mid small cap companies, kind of $5 billion, $10 billion companies, +2. Canadian financials, interesting divergence in the Canadian markets, and you would see this divergence in the United States as well. Canada represents about 18% of the market is energy companies, where that is in the low single digits in the United States. Canadian energy up 38. So if you're wondering why Canada is doing so well, last year it was gold stocks. This year it's energy. So again, Canada is a quirky market compared to the rest of the world. And the good news is we've been favorable of energy. I put the first slide here as silver because this is notables. This was our chart from January where we said, wow, silver looks like a bubble. It had gone parabolic. There's the update. We did own some silver. We sold all our silver. At the time, it was very interesting because we said we saw something we hadn't seen in 50 years. And that was that 1 ounce of silver would buy you more than 1 barrel of oil, which we hadn't seen since 1981. Well, there was actually at the peak, 1 ounce of silver would buy you 2 barrels of oil, never ever seen in history. Well, it's very interesting now because with oil at $94 a barrel and silver down, way down in the 60s from over 100, 1 ounce of silver would buy you about 60% or 65% of a barrel of oil. So we said at the time we prefer oil to silver. These type of relationships and ratios, they tend to hold. I mean, we've got over 100 years of sort of modern history, and when these kind of things skew, as John Templeton used to say, this time is different are the most costly words in investment history. We had 4 themes in January. We said, don't fight the Fed, which is interest rates. Don't fight the tape, which is the direction of the markets. We talked about the overvaluation, especially in the US stock market, and we also talked about the presidential cycle. So I wanted to update you on that. Don't fight the Fed. This basically means the money has to go somewhere. You've heard that from me a lot. Cash, bonds, or stocks. If rates are low and unappealing, you're just, even in negative headlines, you tend to get capital flows away from cash. If interest rates are surging higher, you're going to get some people that just said, you know what, risk-free, I want that. We hit in Canada 1 year risk-free GICs at a bank. We hit 6. Market got pounded in a no recession year, and that's just because capital was flowing away from stocks and bonds into cash. So we started the year with the idea that it was a certainty that US would be cutting rates within the next few months. With oil and with the inflationary impacts of oil, the market is now betting that the next move from the US Federal Reserve Board would be markets bet on Fed rate hike surge. It's not that rates would surge, it's the betting has surged on a rate hike. So the market is now bracing for a possible rate rise. This is shocking. Money markets raise Bank of Canada 2026 rate hikes to 0.75. And you can see this in the 2-year bond yield. Just before the war broke out, you could see year to date interest rates at the 2-year level, because this reflects where people think rates are going, had eased off from just over 2.5% down to about 2.3%. And this is a 2-year bond, and we're right around 3%, which tells you that if the Bank of Canada is at 2.25%, that we expect within the next short while rates to go higher. Again, the 5-year is also interesting, and it's relative to Canada, especially because that tends to hit the 5-year mortgage rates, or even, we're on 5-year cycles, even if you opt for a variable interest rate loan. But you can see that the market is now pricing in not only rates possibly going up in Canada, but staying up and, not declining again. So again, I'm going to get into this a little bit more. I'm skeptical myself that rates would be cut, but I started the year by saying, be careful of don't fight the Fed, because we weren't so sure that rates would be cut. Don't fight the tape. Those are Marty Zweig's 2 rules. And if you look from the sell-off we had last April up until the end of the year when I was doing the presentation, you could see the stock market was going from the bottom left-hand portion of the page to the upper right. And don't fight the tape says that the average investor buys things because they're going up. In other words, I want to get in this trend. The tape has now decidedly moved into sideways territory. If you project out that line where we are about 65, just over 6,500 on the S&P 500, we were there in September, October. So we are now officially into 6-month territory of sideways. So if we say don't fight the Fed and don't fight the tape, the Fed has gone into neutral, no more rate cuts. The Bank of Canada is not cutting. I'm skeptical that rates are going to rise, which is negative on stocks. So we have officially gone, don't fight the Fed, don't fight the tape, into kind of sideways territory. In the call, we talked about the overvaluation of the stock market. Again, these are repeats of the last call. So I won't dwell on that, but the S&P 500 from a valuation perspective is almost dangerously high in terms of price to earnings ratio. Again, people were just kind of chasing things. And, I did point out that the S&P 500 being 40% in this magnificent 7, we said, boy, there's much better valuation outside of that. And so our portfolios have done much better than that because we're not in the sectors which we're skewing the indexes to overvaluation territory. We talked about, now this is where things are changing, okay? Because we talked about the economy watch. And at the beginning of the year, I said I was worried that a CNBC TV survey of market professionals said that there was only a 3% chance of recession. And there are two things you need to have a recession. And one is a yield curve, which means that without getting complicated, the chart on your left is a chart of interest rates, Canada and the United States. When the interest rates are positively sloped from left to right upwards, the economy is growing. When the curve inverts and you have short-term interest rates above long-term rates, that's preceded a recession. Now, if you remember, the curve inverted in 2022, and the unanimous consensus was in 2023 we would have a recession. And we came on our calls and we said, don't be so sure we're going to have a recession, because you need two things. And one is a curve, and the other one that precedes a recession is a spike in oil prices. Okay. With the Strait of Hormuz being blocked, 20% of the world's oil is coming from that area. Oil is an inelastic supply and demand curve. If you go to the pumps and it's 30% more this month than last month, people tend to buy the same amount. If the price of beef doubles, you can buy chicken. But if the price of oil goes up, there isn't an immediate reaction. Thank you to our client, John, who was in Los Angeles, who took a snapshot of this and said, his question was, is this going to affect the economy? Well, I'm going to show you a chart in a minute, but diesel of $7.99 a gallon. By the way, in Canada, that would be $2.91 a liter. Now, again, this is the full serve price, but regular gasoline, self-serve, $6.39. That's way up. And of course, that can affect consumer confidence, consumer behavior. Plus, if it was, say, $70 to fill up your mini SUV, and now it's 110, you might take that delta at $40 and do something else and not go out for dinner. CNBC article: recession odds climb on Wall Street as economy shows cracks. This is a chart going back to the 1970s of oil and recessions. 74, spike. 79, and we had the back-to-back recessions of 81 and 84. 91, you can see the spike in energy before the 09 crisis. Now, not every energy spike leads to recession, but mostly they do. So here we are, but I want to point out the spike of, post, 09 crisis, where energy spiked back up. We're just coming out of recession. And I also want to point out the Russian invasion, where oil spiked, very, very temporary. If oil spikes and it comes as Donald J. Trump says, that it'll be right back down, the damage is minimal. If it stays up, Houston, we have a problem. This is going to affect the economy. I'm going to get back into this. My son Alex, since 1960, put this chart together, the S&P 500 cumulative returns. And this assumes you, year one, your green line, you put your money in the first year of a presidential term, year one, Jan 1, and you take it out December 30th, and you only invest in years 1, or you only invest in years 2. It's very interesting because we pointed this out this year, and while the momentum of the market and don't fight the Fed and don't fight the tape were positive. And by the way, if you look, January was an excellent month. But year 2 is the midterm year. The 16-year total return is below zero. Eh, You know, you got to think, would Trump have invaded Iran in year four of an election term? In other words, the big presidential election year, not, I mean, this is subjective. This is my opinion, but my opinion is they would not do things like that. These type of things tend to happen in year two, which is the riskiest year for stocks. So the good news is our clients have been quite defensive. We know history, and we're faring just fine. So, what can one do in today's environment where the recession odds? Again, this is not the base case, but it's on recession watch. But just people, Treasury inflation protected securities. I know I've mentioned it, but not everyone listens to all my calls. If you go back to 1950, the historical relationship between interest rates and inflation, U.S. real yield since 1950, 1%. U.S. inflation since 1950, 3.52. People don't believe the Bank of Canada, don't believe the U.S. Federal Reserve. They talk about two. That's called moral suasion. They want to convince you that it's two, but the actual inflation rate is 3.52. The average interest rate since 1950 is 4.52. This is incredible. You can buy a U.S. Treasury bond and earn more than the historical average. So normally you beat inflation by one. You can buy a U.S. Treasury bond and beat inflation by 2.05. If you're a little bit more adventurous, you can buy a longer term bond and beat inflation by 2.7. This is a wide margin over. And yes, stocks in the long run have done better than bonds. But stocks at these kind of valuations have not done better than bonds. So there are places to hide. And when we went into the COVID crisis, bond yields were between 1 and 2. And I want to point out, this is very interesting. This is a 5-year chart of the 10-year tips. You can see that in 2021, people were willing to buy these bonds with a -1. In other words, I would be happy. I will buy these bonds. You give me 1% below inflation. 2022 comes along and people said, anyway, you give me around zero and I'm happy. You could see 2023, give me 1. We did have a spike up. These spikes, these 2% don't tend to last. Because they're risk-free. And if people are getting nervous about stocks, where's the money going to go? I want to even 30-year bonds. People were buying 10 years at -1. They were buying 30-year Treasury bonds at -0.5. In other words, I'm so nervous, COVID, I'm so nervous I will buy these. There's so much confidence in stocks there had been that people are shunning bonds. And yet this is exciting to me. As I said, we haven't been able to buy our clients' bonds since before the '09 crisis because they've been so unappealing. But it's very exciting to be able to be balanced and be in something that'll make you good money. Look, inflation had been running. Inflation had been running. Do I have that chart? Oh, this is a little bit out of sync here. This is before this is producer prices, which measures wholesale inflation, tends to lead, again, wholesale prices, not what you and I pay, but what the store is going to pay. Producer prices surge 0.7. Now, we talked about the Trump tariffs. Eventually, it's going to start showing up in inflation. This is before the war. This does not include the recent spike in energy. The inflation rate for the month at the wholesale level was 0.7 for the month. We're going to see an inflation rate that could be 1 or north of 1 on a temporary basis, yes. Holders of TIPS, Treasury inflation bonds, are going to make the 2.7, which is, say, 0.2% for the month, but they're going to get 1. They're going to make 1.2 risk-free from the Treasury. Wow. This is exciting stuff. It may not sound exciting, but again, you're talking to a guy that gets excited about fixed income. I've talked about this for years, but a lot of our preferred shares have gotten called away, and we're selling a lot of our shares at par. But here are three preferred shares that you could buy and hold and probably make money on. Enbridge is a $25 preferred stock. It yields 2.38 plus the 5-year Canada. You get that rate for another 5 years. You're going to buy this at 86 cents on the dollar. Someone's going to sell it to you 14% off what they paid for them when they were new shiny nickel. And because it was yielding 5 point something, you're going to buy it at a discount. You're going to get 6.09. People in Canada, or if you're in the United States and you get a dividend tax break, the tax equivalent yield, you'd have to earn 8.22% on a GIC. Raise your hand if you're not interested in 8.22%. Brookfield, our prime minister's company, who he is the chairman of. This is very interesting because I put one down here. The next two are floating rate. The Brookfield was a $25 preferred share. It's trading at 13. It's almost 50 cents on the dollar. Now, it wasn't a particularly good deal when it was issued. It was 70% of prime. But if you're buying at 50 cents on the dollar, you're getting 140% of the prime lending rate. Prime lending rate is what people borrow at. Prime lending is about 2.2% above the risk-free rate. So, as rates go up, this is the current yield of 5.96. If rates go up, you get a raise. Bell Canada, same kind of deal. It's 100% of prime trading at 80 cents on the dollar. These are exciting things that I think you can hide in. And if I'm right, they continue to go up. As you know, we've been not only my double secret agenda when I buy fixed income is to not only get the yield, but I'm looking for instruments that I believe will go up over time in price if and when we decide to sell them. There's the February PPI. Tips are interesting because most people get nervous and opt not to buy a Treasury inflation bond. This chart doesn't look that dramatic, but this is U.S. money supply. And I want to point out that in 10 years, the money supply has gone from just over 12 billion as to well over 22 billion. So in 10 years, we've almost doubled the money supply. And you can see the COVID spike. Now, what's interesting is when COVID was over and the lockdowns and inflation surged to 9, they rarely do this, but they took the money supply down because they printed so much it was creating inflation. Well, the money supply is the root cause of inflation. Think about it. The population has grown X and the productivity's grown, but at the end of the day, they're diluting our money. If they grow the money supply by 5%, then of course, the next year our money is going to buy 95% of what it used to buy. People shun these bonds because they want to know, well, what's the rate? And I said, well, I don't know exactly what inflation is. So I think the rate will be, 2.5 plus 2.5. I think it'll be 5. People, well, I don't want that risk. I will buy. I mean, people in Canada are buying today 30-year bonds at 2.8. You can buy U.S. Treasury inflation bond at 2.7. So that puts the break-even inflation of 1.1 with money supply that's doubling almost every 10 years. The interesting thing is you really can't see this, but that chart on the extreme right, the money supply is beginning to surge again in calendar year 2026. And it's inevitable that inflation is not going away. So I personally could not sleep at night buying a 30-year Government of Canada bond, knowing that my purchasing power, but at the end of the day, I will take the bond that beats my devaluation of money through printing presses. So I would say that the overwhelming discussions we're having and questions with clients, I'm worried about the US dollar. Um, this is an updated chart, but I want to point out that the US dollar since the 70s, this is the US dollar index, is almost unchanged. In fact, you could see since the '09 crisis, the US dollar has actually been in an uptrend, and the short-term trend has been a lower US dollar. Um, I I'm not, I just want to point that out because people tend to be right now on the headlines very worried. When clients say I'm worried about the US dollar, and I tell them I'm worried too because we're printing money and we're devaluing money, they come to me and they say, well, I'm worried about the US dollar. And I say, well, maybe we should sell our US. And I say, sell it for what? Canadians tend to say, well, they pause and they say, well, maybe Canada. And I say, well, and what are you worried about? Well, they're worried about the US debt. Okay, so let's talk about that for a moment here. You may want to take a screenshot because it'll be kind of small on your phone, but if you're on your YouTube, screenshot this because it's quite interesting. The total debt burden, which includes the household, the corporate, and governments. Okay, Hong Kong being number one. I'm not sure that that's a relevant number because there's a lot of cross borrowing, China, and guarantees. So Japan, Singapore, France outpace Canada, but Canada is way up there at 315%. US is at 264. So we have 50 relative to GDP, 50% more. I will point out some interesting Italy at 236, Canada 315 debt to GDP, UK 214, Germany 200. Just to put some things in relative basis. These are all bad numbers. Debt is a problem, but I want to also point out in Canada, our household debt is the one that is the biggest problem, highest in the world at a time where interest rates have gone up. So let's just talk about the government debt here in the United States for a moment. And I'm not trying to be negative on Canada. I just when money has to go somewhere. We talk about money goes to the cleanest dirty shirt in the laundry. Honey, we're going out for dinner. I got no clean shirts. We'll grab the cleanest dirty shirt in the laundry. This is relevant to an investment thesis. Now, this is from the Fraser Institute. Okay, BC government continues disastrous record in the budget. It's 11.7 billion. It's way worse than that because there was a tobacco settlement for 2 billion that came into general revenue. Um, you know, these are going exponentially higher because in the United States, states don't run deficits. It's only done at the federal level. And so when you include the provinces, and I don't believe that Ontario has had a budget and an update. Alberta, our oil, I mean, province. I mean, 9.4. These numbers are. I mean, that's more than a doubling in Alberta. And yes, of course, oil's going up, so that's good news for Alberta. But I want to talk about just for a second. I don't mean to be a conspiracy theorist, but mainstream media does not like Donald Trump. He doesn't like them. They don't like him. When you Google, U.S. debt, it people are all over it, and it sounds very alarmist. It's very hard to find a negative article on the BC debt problem because it's a socialist government and the media is in favor of them. So it's very hard to find negative news on Mark Carney, the deficit. The deficit in Canada has gone from Trudeau era of 44 billion. We really haven't had a budget update in a long time in Canada. It's 68 billion is the headline, but it's going to be way worse. let's talk about Canada's economy. We have been in the business, our number one area of growth since Justin Trudeau's era has been in immigration. We bring in 1 million immigrants and we build condos for them. This is an unbelievable number, but Canada's population shrank for the first time ever, ever. Why is it shrinking? Because there was a lot of people in this country that were temporary work visas. They're not being renewed, and so some are leaving. So, again, this has been the engine of growth. What worries me in Canada is that the budget deficits balloon worse. Think about, yes, we'll bring in more tax revenue from Alberta's energy companies. But one of the main sources of tax revenue has been in new home construction and new home sales. When we buy and sell in Canada, we have land transfer taxes. Most states in the United States don't even have them. Think about every $1 million condo is 2% land transfer. Expensive ones are 3%. And think about $1 million condo, how much GST, PST, building permits. It's around 30% of the final price is taxes. New home sales in Greater Toronto area have plunged to historic lows with 2020. This is new home sales, marking the worst year on record. And we talked about the housing slowdown. January was the worst January since 1981. This is not population adjusted. These are disastrous numbers. Inventory glut, inventory of condos, 26 months of supply. These numbers are now getting worse than the United States housing crisis were in 2008 crisis. So what worries me is that the tax revenues in Canada are going to fall willfully short, so our deficits will get much higher. We talked about this on the last call. Tariffs, I'm not in favor of tariffs, but they are a source of value-added tax. US, I thought, the deficit in the United States could be solved with what we have in Canada called the goods and services tax, GST. This, they're not going to make these widgets you can buy on Amazon for toys and things in the United States. So you're just paying a tax. So that's not in the budget numbers, but the United States, according to the economists, will bring in at least $330 billion of tariff revenue. The other thing is the United States is growing, and we talk about this for a second. US GDP growth, distorted by government shutdown, came in at 0.7%, but the real number is closer to 3%. Canada's economy contracted. There was no sort of statistical aberrations. This is Canada in zombie land. We're not bringing immigrants, and our economy is stagnating. Are we seeing implications? We're beginning, we talked about this in the last calls. We saw it at Nicola Financial and Romspen and all kinds of Trez Capital, 9 Point. All these real estate funds are gating. Don't worry, there's no problem, but you can't have your money. If you have your money in any of these institutions, get in line, get your money out as quick as possible. So Go Easy is a smaller subprime lender in Canada, riskier loans. This stock was $200 last fall, and it has plunged 75% or more than 75%. And that is because of restating earnings and way lower and big problems. And, people at that level have started not paying. We're starting to see the cracks. I mentioned, 38% return in energy, but we're starting, investors are starting to sniff this out. Year to date, the worst, Canadian financials are more than 4% down. Again, that's dominated by big banks, but Auto Canada, Canada leasing cars, down in half in the last 6 months. We're starting to see the cracks in the Canadian economy. I'm just going to go here for a second. you see it in Auto Canada, you've seen it in Go Easy. Of the big banks, the most vulnerable is EQB, which is the second, seventh biggest bank. It dominates subprime lending. So I believe you're going to see those cracks in the next few quarters. In fact, you've seen it in the last couple of quarters with the surge in delinquent loans, and the stocks of EQB have suffered somewhat, but we haven't seen the big crack yet. The next one is Canada's sixth biggest bank, and many of you will know it because LePoidevin Group used to put our hat there, and that's National Bank. But National Bank, having bought CWB, Canadian Western Bank, National is CWB was headquartered in Alberta, but they do a lot of builder loans in British Columbia and Ontario, and they do a lot of mortgage lending in subprime, and their head office in Ontario is in Brampton. Brampton is the epicenter of real estate declines, and house prices, I was looking at Ben Rabideau's stuff, are down anywhere from 30 to 40%, and we're going to continue to see mortgage delinquencies there. When you know the numbers are the numbers. When you owe more than your house is worth, that's when people just can't find the money. We're beginning to see some cracks. This is one to watch. We saw Ares Capital, Apollo, Morgan Stanley, private credit. This was this magic, Mr. Client. There's no volatility. You look at your statement, you make 8%. This is one of the biggest in the United States. If you're invested there, don't worry, everything's good, but you can't have your money. So look, there are some places to be that I'm not in favor of being of cash. In Canada, you make maybe 3% on a GIC. You pay 53% or so in tax. You're left with 1.5 with an inflation rate that's far higher. In fact, it's going to be far higher. So we talked about this in previous cycles, but please do not exceed 100,000 in second tier GICs. We're going to see some more failures. Go Easies is just the beginning. We haven't seen any failures yet. But I would say that industrials, engineering, rails, I don't want to get into specifics on individual stocks in the presentation, but there are plenty of places to put your money that are not in the bubble area. You're investing with us. We have a decidedly this is going to be a more difficult year. I don't think the sky is falling in terms of the economies, in terms of oh my God, like we're going to have a crash. But I think at the end of the day, you're investing with a team that is not out there. A lot of this work gets done beforehand. We have gotten way more defensive. These types of volatility are not affecting our clients nearly as much as they would have. So I would say that, this is the year where you deploy capital. Again, I'm not in favor of cash, but there's some low risk, fantastic places to put your money that you will do very well on the next several years. The Treasury inflation bonds, by the way, in the 2009 crisis, COVID, if you look at COVID, they went up 40% in value. So, by the way, if you hold some and you say, well, boy, I've lost some money in my stocks, you might end up making a whole lot of money in these bonds. That's not my outlook scenario, but I do think that as people question, I don't think you'll be able to keep Treasury inflation bonds at 2. I think the natural home is more like a 1 yield. So that means that when we go to sell them, someone will pay more than we did. So, that's it. I think I've exceeded my time here. Hope I answered everyone's questions. Once again, if you have any questions we didn't answer, feel free to call. And we'll see you next time. Thanks, everyone.